Alibaba is at its 52-week low with some fantastic earnings this week, as well as a surprise dividend announcement. We're going to uncover all of this information as usual. We're going to take a look at the historical performance of the company, looking at their performance, their top line revenue, as well as their bottom line net income growth after their latest results. We want to look at their total cash versus their total debt. How safe is this company? As well as seeing how they performed on a total return basis versus some of their key competitors. And as always, we will take a look to see what the institutions are doing with this company. We're going to take a look into their earnings, as well as some important financial metrics to support their upcoming dividend and seeing how their free cash flow has been. And don't forget, we will also run them through our stock valuation model, getting to their intrinsic value and finding out our acceptable buy price given that all-important margin of safety. So let's jump straight in. Now, year to date, it is down 16%. It is trading right there at that 52-week low, and it now offers a forward yield of 1.29%, which we will touch upon very soon. Now, shareholders who have been holding the company over the last 10 years, as we can see, would have seen very minimal movement. If we take a look right now, trading at $77.60, and it was trading around $90, so they would in fact be down on their investment if you did buy that at that point. And we can see their stock has peaked at around just over $300 towards the back end of 2020. Now, looking at how this company has performed on their top line over the last 5 years. Now, typically 3 to 7%, remember, is what we look for at companies' growth. 56 billion in March 2019, more than doubled that in their latest report, 126 billion, which is phenomenal, more than double on that top line. When we look on a more granular level, yes, we don't see increases year on year. We see that up until 22, and then we see a small drop in 23. Nonetheless, some phenomenal growth over the last 5 years, which we will touch upon, and we'll look at the last 10 years in percentage form. Now, on the bottom line, a slightly different story. 13 billion reported in March 2019, with around 10.6 billion reported in March 23. So when we look at the granular level, we do see increases to 2021 before a huge drop in 22 before picking up. Nonetheless, these are some very strong numbers both on the top line and bottom line. Now, when we want to do a quick short look at the balance sheet, as always, a quick health check, total cash versus total debt. What we in fact see, around 30 billion reported of cash and short-term investments in 2019. Latest quarterly report from last week, more than double that at around 79 billion. So they are sitting on a large amount of cash. And when we compare that to their total debt, what we can see, this has gone up from around 20 billion in March 2019 to around 27 billion, but their cash, not only has it grown at a faster rate, but also is more than sufficient to pay all of their debt when needed. So it is looking like a fairly healthy balance sheet so far. Now, comparing them to some names in the industry, in the broadline retail industry, we have PDD Holdings, as well as Mercado Libre, which is another company that we can review on the channel if people are interested. Now, total return year to date, we can see Baba down 15.63%, one of the worst performing in the industry, and with Melli here at around 75%, the best performing. Now, as always, when you have more information, it is better to do your analysis. So when we take a look at the last 5 years, what we can see, Baba is still down negative 48% as one of the worst performing, with PDD up around 480% and Melli at around 331%. Remember though, past performance is never indicative of the future, and it is just one level of review that we do. Now, institutions, 14.22% institutional ownership. We do see around 5.55 billion institutional outflows, sales of shares, but nearly double that at 9.25 billion bought by institutions over the 12-month period. And when we take a look quarter on quarter, we can see some quarters where institutions are buying more and some quarters where institutions are buying less. But as always, whatever the institutions do, that should have nothing to do with your own analysis and your own due diligence, but it is just one level that we look at here on the channel. Now, in terms of their earnings, let's take a very quick look. Now, what we can see, the earnings was beaten on the earnings per share at around 15.11 expected in CNY currency, reported 15.63, so a 3.44 surprise. Now, the revenue slightly coming under, very marginal at around 110 million, and this was a negative 0.05% surprise. Now, when we do a very quick comparison year on year, quarter 3 23 versus quarter 3 22, top line increased by 8.5%, bottom line increased by 236%, earnings per share up, net profit margin up significantly, operating margin up as well, but we do see the net change in cash at 55%. So some very, very strong numbers over the last year, in fact, from that year-on-year performance. So let's take a very quick look at the headlines, and we see straight away they do shed around 20 billion in their market value. One of the reasons for this was the plans to list their cloud business. So one of the things that they were looking to do was to spin off a lot of their divisions, and we can see they did announce they would not proceed with the spin-off of their cloud intelligence group. Now, this is really being targeted as one of the reasons for the large drop, and we can see the reason why they've scrapped this is they say the US chip export curbs have essentially created uncertainties for the prospects of Cloud Intelligence Group, which does compete with AWS and Microsoft Azure. Now, looking into this a bit further, what we can see when we take a look down is essentially the investors were hoping that the spin-off entity for Alibaba's cloud business would achieve a higher valuation, with analysts saying their intelligent group could be worth between 41 to 60 billion. Now, there are a lot of reasons why people tend to not invest in China, the regulations, and we can see the market commentators did warn that the listing could attract scrutiny from regulators both in China and overseas. And one of the reasons, or one of the back-end essential outputs of this, we do see Morgan Stanley cutting their price target from the stock to $110 from $150, but you can see straight away it is trading at around $76, $77, so there is still some upside, and we'll shortly run it through our stock valuation model to give you our exact thoughts on the price. Now, one other thing just to note before we look at some metrics is the Jack Ma family do intend to sell around 10 million of their shares in Alibaba, and this equates to around 871 million. Now, for those that essentially do not know this information, he did step down as the chairman of Alibaba in 2019, and the company is currently led by Eddie Wu, who is one of the co-founders. So just a bit of information there for those that didn't know. Now let's take a look at some important financial metrics for Alibaba. Now, a dividend yield forward-looking of 1.26%. Remember, it's the first time they have started to pay dividends. I'm interested below. Let me know your thoughts on whether or not you believe this is a good move for the company, or whether you think they should ditch the dividends and just do a significant amount more of share buybacks. Market cap around 197 billion, so it is a mega cap company. Now, in terms of looking at their earnings per share free cash flow, remember on the channel, for those that are new, we ignore earnings. It is susceptible to manipulation by management through accounting. We tend to focus on the free cash flow. $9.84 in 2014, $63 in 2022. So please riddle me this. How is a company that their free cash flow is growing significantly over the last 10 years now worth less than it was when we took a look at that 10-year? It is worth less. So in 2014, it was around $88 to $99, and now at around $76. How is it worth less, yet their free cash flow per share is increasing, as we can see, continuously and consistently, other than that drop we saw in 2022, with 2024 expected to be higher slightly than that 2023 figure. Sales growth on top of that, you are looking at a company that is increasing double digits. We do see a very small increase in 2023, but even before that, it was very fast growing. And numerically speaking, they have increased their sales from 53 billion to 869 billion. So it is one of those things where people do get scared of investing in China, but I would be interested to hear your thoughts below. 2.33 billion worth of shares outstanding, 2.64 in 2023. So they have increased their share issuances, so diluting your position as a shareholder. So something just to note. Now, when we take a look at the ROIC, we typically like 10% or more. Gives us faith in management and their ability to essentially allocate their capital. What we can see from 2015, it has consistently been around 8 to 12%. I would like to see this higher, but it has been consistently around these numbers. Operating margin, free cash flow margin. Operating margin, we're looking for around 12% or more. It has come down quite significantly from the high percentages that we saw in 2014 to 2018. But it is there at that minimum 12% we like to see. And the free cash flow margin, again, above that 7%. So it is very positive, but do note on both of them, both margins are coming down. And on the net debt to EBITDA, this is something we love to see in companies. This essentially shows the number of years it would take them to pay off all of their debt net of cash on hand. It wouldn't even take them one day to pay off all of their debt. They do have a very strong balance sheet. Now, one thing we're going to look at now is that stock valuation of Alibaba to understand the intrinsic value and our acceptable buy price. And remember, as always, if you do enjoy the content value is being provided, do smash that like button, hit the subscribe and bell button to be continually notified of these videos as they drop. And if you do want to grab a copy of our valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, do click on that pinned comment below. Starting off with Graham's valuation, we have the stock ticker, the earnings per share, growth rate per analyst estimates with that current yield on AAA corporate bonds. Now, this gives an intrinsic value of $94. Now, when we take a look at the share price, it is much higher than the current trading price, but it is within that 52-week range, showing signs of undervaluation in the market currently. Now, do remember, though, we never look at any of these models in isolation, and we'll draw our conclusions towards the end of the episode. We then move on to the multiples valuation model. Companies in a similar sector and size, we have JD.com, PDD Holdings, and Prosus. We have their stock price, earnings per share. We have the average PE, and we multiply that by the earnings per share of Baba to get a stock price of $124. Now, as we can see, that is right there at that 52-week high. In fact, a few dollars higher, showing strong signs again of undervaluation in the current market. Now, remember, the third model that we do use is the dividend discount model, but we will not be using that just because they haven't had a strong history of dividends, so it wouldn't be right to effectively use that. But they are due to pay off their first dividend, which is at a dollar amount. But that will be interesting to see how this does progress over the next few years and the rate that they do increase those dividends. So the third and final model we're using is the DCF model, where we have the discount and cash flow models year on year, and we have recently updated to have that 2023 figure, where we see a 30% increase on that free cash flow over the last year. Now, on average, it has also increased by around 30%. Now, forward looking, we have gone slightly lower than estimates, around 6% to be more conservative. Now, with that discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, arrive at the equity value. We get the shares outstanding, which gives a DCF price of $295. Now, that is significantly higher than the 52-week high, and that is slightly lower than that all-time high we've seen over the last 10 years, showing some significant undervaluation of Alibaba Group holding company right now. Now, the intrinsic value, as always, remember, it is just the average of the models that we run through. And don't forget, if you enjoy the content, smash that like button. It really helps the channel grow. It puts the content out there so that we do increase our investing community. And don't forget to subscribe and hit that bell button so you are notified as soon as these videos do drop regularly. Now, the current price is $77.60 with an intrinsic value of $171. Now, typically 10% margin of safety is what we use if we believe it has a wide moat, strong financial metrics, good forward-looking data. Now, this really does come down to investor preferences. There are investors who may not even want to invest purely because it is a Chinese company due to regulations, or there are investors who are sitting there saying we want a much larger margin of safety. At 20%, it is a buy at around $136. At 30% up to $120. If you move to 40% at $102, and at 50% up to $85. And if we use 55%, it is roughly right there. So you are essentially locking in right now, based on the estimates and judgments we've run through in today's video, a margin of safety of 55%. Now, what do Wall Street say? Well, they believe the price to have some significant room to grow, nearly 100% upside at around $140. So the way this works, essentially what we are saying is right now you are locking in around a 55% margin of safety on Alibaba Group Holdings, whilst also having around 100% upside based on Wall Street price forecast. As always, I'm very keen to hear your thoughts, especially on this company, which is a Chinese company, lots of regulations and lots of issues that I do know a lot of people have worries about. Is this a company you are looking to buy? One maybe you are looking to sell, or even if you're on the sidelines, I am keen to hear why this is a company you are looking to invest in, or maybe this is something you won't touch. As always, don't forget to smash that like button, hit the subscribe and bell to be continually notified of these videos. And if you do want to grab a copy of the valuation model to get to the intrinsic value of companies in your own portfolio and get your acceptable buy price, then do click on that pinned comment. As always, have a great day, catch you on the next episode, and take care.